My name is Omar Khan. I'm an Executive Director and Portfolio Manager at Freehold Investment Management. Freehold, we're a privately owned real estate and infrastructure manager. We manage just over $500 million on behalf of private wealth groups and small institutions, and we've been doing so for 10 plus years. We primarily focus on capital preservation and generating sustainable returns from tangible assets. That's primarily Australian real estate and infrastructure. In terms of ownership, we're owned by management, majority owned by management, and have a significant investor or shareholder in Alcyon Group. In the current environment, where term deposit rates are sub 1%, ASX-listed entities are facing significant earnings pressure, which naturally flows through to dividends. There's been considerable cap rate compression, and which naturally leads to tightening of income yields or property yields. Investors are looking out for alternative options to generate regular income streams whilst also giving them some capital stability. In the current environment, real estate debt or debt or financing secured by Australian real estate and primarily across the East Coast offers such opportunity. In the current environment, you can probably generate 7 to 8% per annum with relatively conservative LVRs. So what is real estate debt? Real estate debt is land finance, that is financing residential land acquisition or for hold while a developer might be going through a DA process or a pre-sale process. Construction finance, that is construction finance for residential or commercial development of assets. Residual stock finance for completed land lots or apartments that are yet to be sold or settled. And finally, commercial asset finance, which is something probably you're traditionally more used to, which is financing acquisition, release, or an upgrade of a commercial asset over a 2 to 3 year period. And generally at the end of that period where the asset is stabilised, it's sold or refinanced to a more traditional financing or bank institution. So within real estate debt, we tend to focus, or we prefer to focus, at the top of the capital stack. That is senior secured first mortgage. And that is because that part of the stack is the first to get paid and the last to lose capital should anything go wrong. And in the current environment where you can generate 8 to 12% per annum, it's a pretty attractive place to be. And if you look at our current portfolio where our weighted LVR is circa 54%, we could afford for land values to drop by greater than 45% before we would lose any principal in any of our deals across our portfolio. Naturally, if you go further down the capital stack, that is in mezzanine or equity, there are higher returns on offer, but with that also comes a commensurate risk. So we prefer to sit at the top of the stack where have the highest degree of security, and we believe on a risk-adjusted basis are very attractive returns in the current environment. So why is this opportunity available? Primarily because banks are reducing funding to the real estate sector across Australia. Now this started back in the GFC and has certainly increased into the pressure from APRA, the Australian banking regulator, has certainly increased for banks to reduce their exposure to real estate broadly, but also specifically real estate residential development. What this has meant is that there's a significant gap in the market, and we focus in the mid end of the market in that $10 to $70 million deal size that is underserviced. And the displacement in funding has allowed groups like us, non-banks, to increase their share to residential lending. And non-banks can earn anywhere around 10% or 1,000 basis points in margin relative to 350 basis points or 3.5% for a similar deal with similar metrics at a bank. And certainly this is full recourse lending environment, so it affords the same style of comfort to investors. And if you look at real estate debt exposure or residential real estate debt exposure across banks in Australia, what you'll observe is that they started reducing exposure around the GFC, and then they started increasing exposure back end of 2013, and again reducing exposure around the back end of 2016. And we've seen public announcements from APRA around that late 2016 for banks to reduce exposure to residential development debt. And if you look at the data, there's a sharp decline in exposure, and we believe the trend is expected to continue through the COVID-19 experience. All that means it creates more opportunity for non-banks like us. Overall, we believe that the non-bank sector Australia-wide probably represents about a $40 billion opportunity. In terms of the real estate debt market, we segment the market into three buckets: small, medium and large. On the small side, typically loan sizes of $2 million to $7.5 million, typical development size of sub $10 million. But what that sector probably lacks is significant track record, sponsor governance, sophistication and maturity. Whereas at the top end, in the large segment, where deal sizes can be $100 to $200 million or $100 to $250, and development sizes of $100 million plus, with institutional grade partners, significant track record, sponsor governance, management depth and quality, but outsized returns tend not to be on offer, primarily because there's a significant volume of capital, both onshore and offshore, that is servicing that market. In the mid-market, where we prefer to focus, deal sizes tend to be, again, in that sort of $10 to $70 million zone, development or project sizes of $20 million plus. Again, institutional grade, strong track records, sponsor governance, sophistication and maturity, management depth, and importantly, outsized returns. So this is the area where we like to focus. We prefer to stay out of the small end because we believe that small end generally lacks the quality and depth that we prefer to finance. And the top end, though it has the quality and depth that we like, probably doesn't have the outsized returns that we'd like to attract or provide for our investors. In terms of the strategy focus, as I said, within that sort of mid-market, we primarily focus on senior loans. We can invest up to 30% of the fund in second mortgages or what we call intermediate capital, which at present in terms of the portfolio, we're 98% senior first mortgage secured, so about 2% in that intermediate capital. Typical loan size, $10 to $70 million. Typical loan duration is 12 to 24 months, and that's really important because that also means that our principal is repaid every 12 to 24 months. Which allows us to offer liquidity windows to investors. So in a typical commercial real estate fund or direct fund, investors are usually locked up for 5 to 7 years, whereas with real estate debt, there's an opportunity to offer investors liquidity windows or more regular liquidity windows. From a security perspective, mostly senior secured loans, personal corporate guarantees, as you would expect, market standard covenants. For construction loans, strong pre-sale debt coverage, independent asset valuations, and we primarily focus on Sydney and Melbourne because that's also where there is significant market depth. From an asset type perspective, we can invest right across the real estate sector, but we primarily focus on land finance, construction finance, and residual stock facilities because that's where we believe there are attractive returns on offer for the relative LVRs or risk. In terms of case study, I'll quickly touch on one case study which is representative of the portfolio, and that is a $33 million land facility. It represents 2 adjacent parcels of land that are fully DA'd. We have an $18.15 million facility against that land, circa 55% LVR, 24 month with a regular monthly coupon, an interest rate in the high 11s with a significant mid-sized player with net assets of $100 million plus. And if you look at that, you think high quality sponsor, high attractive gross returns, fully and conservatively secured against land that already has a DA. Now this is typical of what we find in the portfolio and also the quality that we'd prefer to focus on. Finally, in terms of returns, the fund has generated 8.63% per annum since inception. We've provided or distributed each month except for the very first month of the fund's operation. And what you'll find is that there's a small difference generally between the net return and what is distributed each month, but the fund does not generate capital returns or provide net capital gains. But usually there's a timing difference between when that interest is accrued and paid to us, and hence a difference to when the interest distribution is paid to investors. Over 12 to 18 months, we expect that all net return is distributed to investors. I hope that was reasonably clear in terms of what real estate debt is, where we focus, how the fund works, and the returns we've been able to generate for investors to date. Should you have any further questions, please don't hesitate to reach out. You can jump on our website at freeholdim.com.au, or there should be a form at the bottom of this page as well, which you can complete and reach out to us. Thank you very much.